Welcome, everyone. Thank you for joining us this morning. We are going to be talking about how to increase returns and decrease risks for your real estate investments. We have two team members from Unbridled Wealth. You may recognize Mike. He was in a webinar with us, I believe, in May or June, maybe even July. It's been a while. Well, and now we have his special guest, Ryan Haley. Ryan is a real estate investor, a business owner. He was a former U.S. Navy helicopter pilot, and he wrote a #1 best-selling book. Both Michael and Ryan help develop plans and strategies for all sorts of clients to maximize their cash flow, to help them find more joy in life, to build a more impactful legacy. Michael was once an educator, just like me. We were both in the school system, so we both have that passion and joy for helping and educating people. So you'll definitely be able to feel that and tell in today's webinar. Alrighty, let's go on. So some more events that we want to let you guys know about. We have some new attendees in here, so we would like to inform you all about some upcoming webinars. So maybe this won't be the first and last, but this is just the first of many. Tomorrow night, we have our BRRRR and short-term rental webinar. It's our monthly meeting at 7 p.m. Anish is going to be taking over that one. We have some special guests. We're going to be talking a lot about rehabbing and things like that. We're going to have a contractor, lead contractor on our webinar, so don't miss that. And then next Wednesday, the 13th, we're going to have REA Black Book back again to talk about the 3 steps to triple your business without extra marketing. And we have a very special event coming up next month, November 6th. This year, Bria is a proud sponsor of the Soldier Rush Race. It's going to be at Parkland Equestrian Park. We are going to be supporting veterans, first responders, those suffering from PTSD by participating in the Soldier Rush Race. We hope to see you there. We haven't seen a lot of you guys in person in quite a while, so some BRIA members will be there. Hopefully we can all come together as a family and support all of these people through a really fun event. It's going to be like an obstacle course where the whole family can participate, and the funds that are raised in this event go straight to Fitness on a Mission to help support these folks. So you can participate or donate. We hope to see you there. More information will be in the chat at soldierrush.com. We also want to let you know about our mentor program. So if you are liking some of the information that you are hearing today from us BRIA members, if you want to know a little bit more about how to use this information, maybe in your wholesaling or real estate investing career, definitely let us know. And we're going to put a poll up right now if you want to know a little bit more about our mentor program. I know we have a lot of students in here already, but I know I do see some new faces as well, or new names. We have a really, really special giveaway today. We're going to have 4 lucky winners. Text the word wealth to 954-737-3239, and 2 winners will be able to get a book set handpicked by Mike Fernicola himself. And 2 winners will be able to get a 1-hour financial review with Mike. This is invaluable. It is going to be really great information. So all you have to do is text wealth to 954-737-3239. We have member benefits if you would like to become a member with us. This is going to be really important, especially in 2022 when we start doing in-person events again. If you'd like to know more about our membership, you can check out the link that just popped into the chat. And we would just like to say a special thank you to all of our sponsors. And without further ado, I would like, unless Alexa or Anish have anything else to say, I would like to pass the baton on over to Mike and Ryan.
Awesome. Thank you guys so much. Anish, Alexa, thank you so much for having us on here. Obviously, it's always great to spend some time with you guys. You guys are phenomenal. And so we definitely appreciate it and the kind words.
Yeah, and I'm just gonna, before you even guys get into it, I'm gonna let obviously I'm excited to have Mike and Ryan here. We did have Mike speak before. So some of the stuff that he's teaching, I am actually using a lot of those strategies, not all of them. So I'm actually excited because even in our pre-meeting, they were talking about stuff I had no idea about. And I'm excited about it. So I'm also a client. What's that? The hair for men? I'm whatever that phrase is, but I'm super excited. Again, there'll be a replay also. Do not get overwhelmed, right? So I'm going to give you some basis here that a lot of times, people that are new to this, the first time they're hearing this, they're overwhelmed and confused. I was one of those too, until you start putting into action and you have the right partners. They're the experts. So you don't have to know everything. So just pay attention. It's gonna be a lot of good stuff. If you got questions, again, put them in the Q&A. We'll try to get to as many questions as possible. A couple of little rules. I know you're gonna have some specific questions on your situation. So we'll put Mike and Ryan's info throughout so you can reach out to them. But if they're super specific, I might not get to them. So think of it as a question that would actually help out the group. So we could kind of keep it going also at the same time. So it's all yours, Michael, Ryan.
Yeah, thank you, Anish. I appreciate that. And it's a lot of information. And so the best thing to do is definitely sign up for a one-to-one with us, or so that we can really break it down for your exact situation, which we'll have that in a little bit. I'll throw that on the screen. And so before we get started, the information provided is not presented nor intended as specific tax, legal, investment, borrowing, or lending advice. I'm not a CPA, we're not attorneys, I'm not a mortgage broker, but we are going to be diving into some phenomenal strategies that you could take advantage of as real estate investors, as people, and as people that wanting to leave a legacy and kind of advance your future. Before we begin, and Alexa, you talked a little bit about me, but I just wanted to introduce myself. My name is Mike Fernicola. I'm a husband, a father, an investor, and an educator. I've been I was a former educator for about 8 years. I loved kind of putting the building blocks together for students and having them learn everything and come out ahead and come out on top. And then while I was doing that, I'm also a private money lender. For the last 5 years, me and my wife have been trying to get our money moving. And that's kind of how we found out how to invest with IBC and utilize that and take advantage of those multitasking dollars, which we'll get into. It's been about 2 years. So after learning about IBC, I was like, man, I'd love to be a part of this team because of what their culture is and how they were kind of putting things together. And I think I could speak for everybody on the Unbridled team. We were all clients before we were advisors. And so we really found that this could help people so much more than just by educating them. And so that's kind of where we are. And I'd love to introduce my colleague, Ryan Haley now. He's going to just take it away.
Yeah, thank you guys. It's really great to be here. I've heard a lot of great things about this BRIA, and I know Mike worked on the last one, and it was able to work with him and helping some other people, which we'll talk about. But yeah, my name is Ryan Haley. I am a former Navy helicopter pilot in a former life.
Yeah, and hold on, he has a fun story about being a Navy helicopter pilot. You should definitely share that a little bit.
Yeah, I don't know if fun is the right word, but I certainly say it's interesting. I was actually in a helicopter crash in 2007, and luckily myself and the crew all walked away with minor injuries, but was in a helicopter crash and survived to tell about it. So that was an interesting experience, to say the least. But I got out of the Navy after about 11 years in 2014, and that's kind of when I started my entrepreneurial journey. Did a bunch of different things, but I became a pretty dedicated real estate investor in 2017, and I'll share a personal story about that as well. And then I'm also a content creator. I've got a book that I was blessed to have Tony Dungy write the foreword to, and partnered with him on that. And then I'm also a podcast host. I talk about business, faith, finances, and like to share all this stuff. So hopefully you guys will get some value out of this today. And I'm looking forward to getting to know some more about you guys.
Yeah, so this first slide is a beautiful picture of an iceberg, right? And what we see in the top of that iceberg is something called common knowledge. This is what we've been told to do with our finances, with our life. This is the thing that is so evident to us because everybody's doing it, or it's just very, it's common, right? It is what we are known to have taken advantage of, whatever it may be. This could be investing in an index fund or a mutual fund or whatever it may be that everybody's doing. But we see below the water that there's this other part of the iceberg, right? And this is called uncommon knowledge. These are the things that we don't know that really could benefit us. One of those things is the flow of money, right? How do we get money working for us and moving to us and not away from us? A guy, Nelson Nash, who is actually the father of IBC, he says that if you divvied out all the wealth in the world to all the people in the world, in 5 years, 3% of the population would have all the money that was divvied out. And he says that because that's how 3% of the population knows how to get money moving towards them and not away from them. So the flow of money is super important. And we're going to dive into that a little bit today. The next thing is uninterrupted compounding, excuse me. And so we know what compounding is, and that is the ability to kind of compound wealth, keep it moving. But what does it mean to be uninterrupted, right? That uninterrupted compounding would actually have a better effect than even just regular compounding. In the stock market, when you take that money out, when you lose money, it interrupts what was compounding. And so we're going to dive in a little bit of that as well. Lost opportunity cost. As a private money lender, we see this quite often where I utilize my money. Let's say I collect 10% on a deal that I'm funding. And then next door, a duplex happens to foreclose, and I could have made 20% on that by having that money in hand. I lost out on the opportunity to invest in my backyard because I was invested somewhere else. And then the last thing, and probably the most important, is this multitasking dollars. And that's probably the most confusing as well. How do you get your money working in two places at once, right? How do you allow your dollar to work in multiple facets and multiple areas at the same time? And so we're going to dive into all these things today and kind of show you a little bit of how we utilize these uncommon knowledges. So Ryan, if you want to pull up your slides.
Yeah, Mike, I think that those are some really important points that you brought up. And I think that's part of what I want to get into here is having a knowledge of that stuff that's kind of beneath the surface that we don't always see is really important. And I don't know about you guys as real estate investors or business owners, but for me, I found this current environment to have a lot of challenges. You know, we've got taxes, which are definitely increasing quite a bit. We've got inflation, which is probably the highest it's been in decades right now. And at the same time, we have interest rates near zero. So if you're trying to get any kind of return from, you know, a checking or savings account, any kind of safe, you know, high yield or high grade bonds or treasuries, you're getting pretty much nothing and you're losing to inflation. And at the same time, that's causing asset prices to get significantly overvalued, whether that's real estate, the stock market. There's a lot of just cheap money chasing returns, and that's driving all the prices up. So overall, that makes risk-adjusted returns lower and unattractive in a lot of cases. And it also, I don't know about you guys in your local area, but it makes good deals hard to find in a lot of cases. So this is an interesting environment where this is something that Ken McElroy said, who is part of Robert Kiyosaki's team. He said in this environment of high inflation and near zero interest rates, cash actually can become a liability, but debt can actually become an asset. And that sounded so backwards to me, and I had to kind of wrap my head around that. But we're going to talk a little bit more about how that all works. But overall, that kind of makes just this is an environment that punishes savers and responsible investors. And we see a lot of speculators that are, you know, making a lot of money, but it doesn't seem like a sustainable long-term solution. And that's something that I've struggled with. I don't know if that's something anybody else has been dealing with, but what we want to talk about today is a way to kind of turn all these things to our advantages. So what if you had a special banking contract that would allow you to have your money working in multiple places at once, like Mike said, those multitasking dollars. So you could be earning compound interest where taxes are deferred or even eliminated entirely on the growth, and then be borrowing and paying simple interest that could be tax deductible minimizing your tax burden, and putting that money to work and getting a return in two places at once. And that, in an essence, is what we call the quote unquote infinite banking concept, or IBC. So Mike, I don't know if you want to talk a little bit about the three types of people and how this relates to what I was just talking about.
Yeah, so at Unbridled Wealth, we believe that there's three types of people. The first type is the debtor, right? This is somebody who takes out loans and has to pay them back, always kind of going to financial zero and never really owning anything. The next type of person is the saver, right? And these are the Dave Ramseys of the group. These are what me and my wife are and are really good at. We enjoy saving and kind of building. And so we save up and then we pay cash for things. But we always end back with this financial zero where the debtor was as well. And so there had to be something different. And that's kind of where this IBC strategy comes into play. And so there's something, the other person is this wealth creator, right? And this is somebody who understands that some debt is good debt, right? And building a business or getting a mortgage on a house, right? With that, you create long-term wealth, but also in utilizing a policy and utilizing simple interest and building compound interest is how you become this wealth creator. And later on in life, have phenomenal gains that are tax efficient and be able to really sustain the lifestyle that you want and also to purchase the investment properties that we want.
Yeah, I know this is kind of, again, probably new concepts for a lot of people, and we're going to go over this, with several layers, but we kind of want to just get this foundation set. And what Mike just said is really important, and that's what this strategy is all about. So when I talk about, this special banking contract, what do we mean by that? And basically that is a properly structured, and cannot overemphasize properly structured enough, maximum overfunded, cash value optimized permanent life insurance policy with a well-established mutual carrier. Now, just honestly, from the horse's mouth here, when you guys hear about permanent life insurance or life insurance in general, I don't know what you guys think about. I know I had certain conceptions, and listening to other people who had certain opinions about it. Mike, I don't know if you had the same experience when you first heard about this.
Oh, definitely.
Yeah.
Oh yeah, Anish?
I was just going to add, like, Ryan, it's a great point. Go ahead and put it in the chat. A couple of phrases of what you think about life insurance.
Yeah, that's a good
Keep
idea.
it clean, guys. Keep it clean.
Yeah.
Go ahead, Mike. I'm sorry to interrupt you. I'm always kind of curious because I was the same thing. I was like, life insurance. I'm not 80 years old. That's what my parents talk about.
Yeah.
I'm too young for that. So.
No, it's true. And I think we always have this bad misconception about life insurance because it all depends on how we structure it. And I think that properly structured, that underlined words there up at the top really make a difference in how life insurance works and how it's supposed to help us rather than be a burden for us. And so,
I don't know if you see in some of the comments, like, some people think, they've heard term life insurance is the way to go.
Term life,
right?
yeah.
So there's a lot of information out there. I'm just not going to say a lot of it's good information, but it depends. Like, everything's a depend thing. So I'm not the expert, but that's what I always thought. I always talk to a lot of people. I have some close friends. That's all they're doing is term life. I actually have one of our students, his mom's been paying term life since 1995.
Oh my goodness. Wow.
Yes.
Wow.
So.
Yeah. So awesome. Yeah. If you want to keep it going.
Yeah, I just want to comment on a couple of these things. I appreciate you guys weighing in with your comments here, because, these are very typical responses. And I know it was the same thing for me. So we're going to address a lot of these things because there's a lot of misinformation and half truths out there. It's really important to be educated. I will say, if it's not properly structured, then the Dave Ramseys of the world are totally right. You should buy term and invest the difference. But with what we're going to show you, it's a completely different model that turns all that on its head. And when used properly and structured the right way with the right long-term plan, it can be a huge benefit. So,
Russell's comment is really good too. It says, investment when it wasn't a good investment when I reviewed it. And I think we're going to get into that a little bit more down the road in these slides. And I think it's not a great investment if you're looking at it as an investment, but it can be a phenomenal tool to utilize for your investments. And so that's kind of what we're going to get into in a minute here.
Yeah, absolutely. So yeah, this is, like we said, people talk about buy term and invest the difference. We're going to talk more about that. But when we use these strategies and what Mike was talking about with the wealth creator, those investment challenges that we've been facing can now actually be turned into opportunities and advantages. As you guys probably know, there are some pretty significant tax changes on the way, not too favorable for a lot of people that are investing in real estate, business owners. And we'll talk a little bit more about some of those changes and how we can possibly pivot to avoid some of those negatives and actually obtain some positives. But one of the big things that a lot of people didn't know about was at the beginning of this year, the IRS tax code changed a significant revision for permanent life insurance that actually is one of the most significant favorable tax revisions in decades that makes this infinite banking concept significantly more effective than it already is. And we'll talk more about that. I just find it interesting in a time when so many things are changing, not so much for the better in a lot of ways, that this same year that happened. And that was a very encouraging development. Also, when we talk about inflation, that can actually be a good thing if you're investing in hard assets like real estate that are going to at least pace inflation, if not outpace it. And that can actually cause you to benefit from it. And like Mike said, have that money moving towards you instead of away from you. Interest rates, again, not so great if you're a saver, getting 0.01% in your checking or savings account. But this is great for borrowers at low rates. And it also presents what we call arbitrage opportunities, which we'll go into in a little bit. And then asset prices, when you're using this strategy, they can be mitigated by this excess return we'll talk about with the infinite banking concept. And so that can make risk-adjusted returns that were previously pretty unattractive significantly improved. Another thing that I'm going to talk about in my personal testimonial is that I have now the patience to wait for good deals, or it can improve an existing deal I'm considering, kind of get me off the fence. And that puts cash back in the asset column when it's inside your policy or your quote unquote private bank, as we unofficially refer to it. So yeah, I appreciate a poll just came up, and this is a great question. This is what got me into IBC in the first place. Do you have a lot of idle cash in checking or savings accounts or equity within a property? So we'll just give a couple minutes to let those numbers come in. But that was really, for me personally, what got me into this in the first place, as I'll talk about shortly.
Yeah, I think this is a phenomenal question. And, we're seeing about right now, 65% says yes, 33% says no. And so, I think this strategy, what we're going to get into a few of the case studies today is going to be, hey, how can we access kind of that equity to build something for longevity and for liquidity? And then also, if you have that cash sitting in checking account, like, make sure that that is working for you and not against you, right? With inflation rates, I think going to 6% or something this year, it's really not a great idea to have that sitting in a checking account.
Yeah, great point. And I see, looks like about 2/3 of the people who weighed in do have idle cash, and that is something we're going to address, and that's good to know. And for those of you who don't, good for you for having it somewhere else. But if it's something that you can benefit from seeing how this works, then that's what we're hoping to show you guys, is a menu of options that can just give you some different approaches to things that you might not have thought about. So appreciate you guys taking the time to go through that poll. In this environment where we're using these things to our advantage, now we get to it rewards savers and responsible investors. And that's something that Mike and I can both speak about from personal experience.
Yeah.
So Mike, you want to talk about kind of the long-term strategy and mindset that this strategy kind of requires?
Yeah. So, I mean, this is definitely a long-term strategy. This isn't a get rich quick scheme, right? This is not an overnight success, but it is a get very rich over many years strategy, requiring three major things. It requires patience, consistency, and financial responsibility. And as investors, we kind of know these three things because, one, you need patience for deals. You need consistency when doing deals, and financial responsibility. If you over leverage, if you do, you evaluate the property too high, right, you're going to not be in a good position to make a profit on those properties. And so I think all these things as investors, you already have, And so just having this tool in your pocket to utilize and have long-term growth outside of even the properties that you're dealing with, I think it could be a phenomenal fit for a lot of people.
Yeah, and one thing I'll just add to that is that when we talk about long-term uninterrupted compounding, I've found that that is true, obviously, of interest, but it's also true of just having a very consistent, stable plan and strategy that you don't fluctuate from over time. That, you know, knowledge, experience, and sticking to a plan through thick and thin can have a huge compound effect as well. And those things come together. So those are some great points, Mike. And I think that's just an important thing to kind of set the foundation for this, that this is going to be a, the tortoise wins the race over the hare kind of a thing. And we'll show you, that can be very significant over time, but it's just, I think, important to have the kind of right mindset going into this.
But I will say too, that it's not that you have to wait. So a lot of what we'll be discussing is in life insurance and whole life insurance with typical and traditional planning, it's a long-term play. But here we have short-term investing mindset to be able to use that capital, right? So the goal is to use it, not to wait for 18 years till you have accumulated wealth. And so we'll show you that in a minute.
Yeah, that's a great point, Mike. And that goes to what we're about to talk about is when most people think about insurance, the traditional policy, understandably, most people are trying to minimize their premiums or the amount that they have to pay and maximize the death benefit. With an infinite banking policy, it's actually the exact opposite. We are trying to maximize premiums and minimize death benefit.
Yeah, and I just want to point out the elephant in the room, right? Because whole life insurance is supposed to be the more expensive insurance, right? And so now it's the more expensive insurance and we're maximizing premiums. It just, can you explain that a little bit, Rye? Because that, obviously, I'm sure some people are thinking that right now.
Yeah, absolutely. It seems completely backwards. But when we're looking at this strategy from the standpoint of not primarily trying to maximize death benefit, although you certainly get a lot of that, and that creditor protection that comes along with it, which is really great for Florida. It's got some of the best creditor protection laws in the country. But when we're looking at this primarily to maximize the cash value in the policy, that is what we can use to fund those real estate investment deals. And the more cash value you have, the sooner, the more you can deploy at a higher rate of return and really kind of jumpstart that compounding process. So by structuring these policies where we put the maximum amount in for a given level of death benefit, not overpaying for insurance, we're reducing the costs and expenses inside the policy. And that's going to make that cash value grow and perform a lot better over time. So the reason we do that, Mike, is because we want to optimize cash value, and the death benefit isn't necessarily our primary consideration in the context of being a real estate investor or an investor of any kind. Now, I do have to say, just for being compliant and making sure that the life insurance industry doesn't lose its tax favored status and people don't take advantage, the primary purpose of life insurance is for death benefit protection. All other benefits are purely ancillary, and that's true. However, it turns out those ancillary benefits are really significant and they lend themselves really well to a real estate investing strategy. So that's what we're going to focus on for most of this presentation. So Mike, do you want to talk about a little bit of how not only are we structuring the policies differently, but how we're accessing the liquidity?
Yeah, so this idea that borrowing versus withdrawing is super, super important. And if you want to hit that next one. So the idea that compound interest is growing while we're using it, and then we're paying simple interest. So we're earning compound and paying simple. When you can earn compound and pay simple, it has a significant advantage, even if it's the same rate or a lower rate. And so because compound interest is continuing to grow and that simple interest is being paid, it becomes a phenomenal tool in our pocket to consistently earn, and it's uninterrupted as well.
Yeah, that was such a huge concept. That's definitely one of those beneath the iceberg unseen things, the uncommon knowledge. Because I didn't even think about this. And I actually just ran some numbers because I'm a huge finance nerd and did a bunch of spreadsheets. So I actually looked at, if you paid, let's say you're earning 5% compound interest and paying 5% simple. Well, you're going to be way ahead, in a fairly short amount of time. But then I looked at it and I said, what if I was earning less? What if I was only earning 3 or 3.5%? compound, but paying 5% simple. Well, you're going to be behind for a couple years, but over time, you're still going to be way ahead, even if you're earning a lower rate than what you're paying because of that difference between compound and simple. So I think that's something that is really important that a lot of people don't necessarily think about.
Yeah.
Now, the other thing is, luckily for us, we don't earn a lower rate than what we're paying. And that's what the second thing is called positive arbitrage. And that's just a fancy term for saying that you're earning a higher rate than what you're paying. So generally, long-term, again, there's a lot of variables, but a pretty conservative long-term projection for these policies is you're going to earn a 4 or 5% long-term return. And we can get cash value lines of credit through third-party lenders for as low as 3% right now. So not only are you benefiting from compound versus simple interest, but you're also benefiting from a higher rate that you're earning versus what you're paying. And that is what the interest rate spread, which is what banks do all day, every day. So you got both of those things working together. You're earning higher than what you're paying, and it's also compound versus simple. And those two things just by themselves are really significant. But then we add on top of that tax efficiency at multiple levels. And this is really, really significant over time if you run the numbers. Like we talked about before, that compound growth that's earning inside the policy is not taxed. And when you take a policy loan to, say, invest in real estate, that policy loan is tax-free. And also, in certain cases, if it's for a qualified business or investment expense, like real estate many times, you can actually get a tax deduction on the interest that you're paying. So now we're starting to stack all these things. We've got compound versus simple interest. We're earning a higher rate than what we're paying. We're not getting taxed on the growth and the liquidity, but we could get a tax deduction on the interest we're paying. And that sounds pretty amazing. And I think that's probably something a lot of people haven't thought about. But Mike, what are some of the typical objections or questions you get when people are looking at, doing one of these policies?
I mean, I think what was the question again? Sorry.
Like what is, I don't know about you, but like with a lot of people I'm talking about with these policies, they're like, okay, this is cool. I can see that I'm earning, maybe call it 5% long-term. Do you ever get those kind of questions?
Yeah, especially on an investor, when we're talking to investors, because, you can make, when we're holding it apples to apples against an investment, the investment is going to be a better return. I can make 20% in 15 to 20% in real estate. And so I think that is a big thing in which people say, well, why would I want to invest in a policy? And this is where that multitasking dollars comes in, and where this is kind of the most important thing, right? Because now you can have your money working in two places at once. And so it's not an or strategy, do this or invest. It's an and strategy. We want to combine the two, because now you have your policy working for you, and then you have your real estate working for you. And so now you can earn that 15 to 20% in the real estate. And if it's floating through the policy, you're getting that compound interest over time, where you're increasing that percent as well. And so it's just a huge return when you're using both and.
Yeah, that's by far the most important thing, I think, that of anything we've shared so far. It's not, why would I invest in a policy instead of real estate? It's, the policy is not the investment itself. The policy funds the investment, like real estate or whatever it is. And it's more of a banking mechanism to get that excess return and get that money working in two places at once. And, if we have time later, I can show you an example of how this works with a real life client example that was literally doing the exact same thing he's already doing. He's just funneling the money through his policy instead of paying it directly out of his Wells Fargo checking account, for example. And it was a phenomenal difference over time. So I think that's probably the biggest thing for people who aren't familiar with the strategy, is that you're not choosing one or the other. Like Mike said, you're using both and those four things, when you add them all together, are really significant and make an enormous difference.
Yeah, no, that's phenomenal. If you want to hit that next slide, we're going to get into a few questions. I don't know if there's been questions in this, or there's anything in the chat that we want to discuss.
Yeah, we're good for a little bit. I know I got a couple of people just asking, like, they want to see some real life examples.
Okay.
So I know they're excited about it too. So
And so if you've, obviously we're going, but I know some people are on lunch. And so if you're on lunch and you want to set up a 30-minute meeting with us, we would be happy to. You could scan this QR code with your phone. It'll take you right to our Calendly, and you could pick a time, or you can email or phone, whatever works best for you. And then we can set something up. I'm going to steal that screen real quick, Rye. Awesome. And since there's no questions, we'll just get right back into it. So we have obviously covered a ton of stuff. And so if you do have questions, we'll stop and kind of answer those as we go. I'm going to kind of get into, you can see my screen, right? Just making sure. Perfect. Saver versus the wealth creator, right? The saver, and this is what I said, kind of me and my wife are, and this is how we looked at it, is we save up and accumulate in our bank account, right? And then we purchase a property. We get back to that financial zero. The strategy here is to save and transfer away wealth to pay for things, then start back over for that next purchase. And what we saw with IBC is, what if you never have to lose your basis, right? What if you never had to give away your wealth in order to invest in these properties? And so that's where this wealth creator comes in. So the same saver mentality, you save up and put money away. And let's say you saved $100,000. If you knew that $100,000 could grow to 480 in 40 years, that's great. But now you're saying to yourself, and I'm sure you're thinking, well, I have 4 properties as a saver and I have no properties as a wealth creator right now. Yeah. And so you probably have more money within the saver at this point. But the point is not to not use that money. The point is to use that money to now invest. And so what we're going to do is buy those same 4 properties that we would have if we were saving, except now we're using the policy as a collateral loan. And then we're paying that back and buying another, paying it back. And what we see in this is that every time we're buying a new property, our baseline, our funding is now at a higher level just by putting it in this vehicle. And so at the end of 40 years, we have $480,000 more. And so every decision comes with a cost. Utilizing cash came with a cost. And so that decision to use cash instead of a policy lost out on opportunity to have about $480,000 additional in this scenario. And so that's kind of the point with utilizing this policy as a funding for funding our investments. Did you have anything to add about that, Ryan?
Yeah, I've got a couple of comments come in and I just want to address those. That's a really important point. Again, we're trying to layer this multiple times, but you can be using this infinite banking concept, not just with the life insurance policy, but also with the property. By not selling a property, but collateralizing a loan against it through a cash out refi or a HELOC, you let that compound basis keep increasing uninterrupted in the property. And then you can buy more properties and keep doing that over and over. Well, you can do that at the same time with life insurance. And we're going to talk about that too. Just wanted to mention too here, we got something in the chat. I think that might be an old link for the Calendly appointment. So if you use the one in the QR code, that will be the best way to get in touch with us. But I also wanted to address, I'm sorry?
I was using the link that was on your website, but that one's not good. No.
Yeah, we can, I can
Okay.
put, actually, Mike, do you want to just put that Bria one in there that we have that's the same as the QR code?
Yeah. Do you want to, I think you have that one or no, or you want me to get it?
Yeah, I was just going to answer a couple of questions before I move on, because they are really great from the perspective of somebody had a question about, is this better than using your IRA for real estate investments? And that's a great question, because some of these tax changes, and I think Anish can probably speak to this too. It looks like there are some pretty significant changes that are going to limit what you can do in a self-directed IRA, including real estate. And this could be a great supplement or replacement for that strategy. And I don't know if you.
I'm just going to add to that, is saying that you could do the answer is yes and yes. Do both. Yeah. Meaning, you can only dump so much money into your self-directed IRA per year, or some of the things you're doing. If you have quote unquote extra money, if that makes sense, laying around, and we're talking about inflation or just sitting in your bank account, there's other ways to actually use that money. And I didn't, just to be totally clear on this, was like, I understood the concepts, but not fully until I did it. And I was like, oh, and I've been doing it for about 3 or 4 years. And now I'm starting to see those numbers like, oh, like really compounding. So it really kind of changes it. But everything you can't put in a self-directed. So I do both. So the idea is that it's another way to diversify too, because what do you do if everything's in one type of investment vehicle? And I know you guys will talk about it a bit later, but you could do this for limited amount of money to even get started. It's the same thing that, hey, maybe you didn't want to put money in your traditional or Roth IRA, and now years later, it's starting to grow and you're starting to see the difference. So.
Absolutely. And somebody else asked a good question that we can address is, does this strategy work for older investors due to higher insurance rates with increasing age? And that's a great question. Actually, I just issued a policy for my mom who's 73. Now she's in good health, but obviously 73 is not the best insurance rates you can get. So you can use somebody else as the insured for the underwriting who's young and healthy and have way lower rates, as long as there's what is called an insurable interest. So if it's a family member, that's usually pretty clear. If it's a business partner, you can use this as part of a buy-sell strategy. That's a whole other thing that we could talk about at a later time. But you don't necessarily have the policy owner does not have to be the insured. So that's a way that you can get somebody young and healthy to get way better rates and make this work better for you. So that's definitely a great question. And it's something I literally just did with my own family. We used my sister who's young and healthy and, got a great rate. So it's going to work for everybody. So there's a lot of advantages to doing that.
Ryan, can I just do the follow-up question? How young can you start actually getting insurance? Can you get it for kids or, that kind of, is there an age limit? If they do follow the insurability, portion, can you do it for your kids?
Absolutely. You can start off with what's called a juvenile policy. In fact, that's what I plan to do as soon as I have kids. Is the second that they come out of the womb, I'm getting them policies, because I know the power of this compounding over time. I mean, my dad did me a huge favor by starting at 24. I'm like, man, what if I had started when I was 0? So you can get juvenile coverage on your kids up to certain limits. And then once they become 18 or a certain age, you can transfer policy ownership over to them. And that is not counted against your coverage limit. So that's a kind of a hack, if you will, to get more coverage at the, without having to qualify any other way.
Yeah, and I'm going to use that as and the reason I'm bringing it up, because I know a lot of people that I get to meet, you want to get into real estate investing. The first job is you want to make your money. Second is to keep it legally, right? Pay the least amount of taxes. And then the third is they always want to leave a legacy. So I know you have clients that it's a great way to build a legacy too. So.
Absolutely.
Yeah. And I think going along with that too, since we're talking about kind of juvenile policies, if let's say Ryan were to get his son or daughter a policy at 0 and work his way up, when he is 18 and he's going to college, instead of pouring into maybe a 529 plan that you started, right, this could act as a 529 plan. And it's not going to have the issues of, well, what if he doesn't use it for college? What if he does this? What if he does that? And so, yeah, this poll question, are you looking for an alternative to a 529 plan for education funding? This could be a phenomenal alternative where it's not as strict and you don't have to use it just for education.
Yeah, that's one of the huge advantages, is that there are no limitations like your typical qualified retirement plans, like a 529, an IRA, a 401k, where there's taxes and penalties if you take it out before a certain age, if you use it for a non-qualified purpose, or then even on the backside, having to take a certain required minimum distribution. That is all totally avoided with using this. And in fact, I've actually used one of these policies for an alternative college funding plan for a client, because they saw the limitations. They're like, well, what if my kid doesn't go to an institution of higher learning? What if they want to invest in real estate or, start a business or any number of things that's not one of those, officially on the list of the IRS. And so they stopped contributing to their 529 and their kids' Roths, and they started doing this instead, because that gives them that added flexibility.
Yeah.
And we're just going to let the poll come in. I got a little bit more
Well, I
interesting
think I
in here.
just ended it.
Oh, okay, did you? And then lastly, I think this is an important question to ask. Somebody said, can you comment on the potential of rising rates on the lending side versus a fixed rate over the term of the policy? And then what is the lending rate used? Those are great questions. So yes, you have the option within the care. You can borrow directly from the life insurance company, and they will usually offer a fixed or a variable rate. And there's different implications to that and scenarios where you might want to use one versus the other. But one of the things is the the option to switch back and forth. And so if rates ever started to go up, really high, you've got a lifetime guaranteed maximum interest rate inside the policy that you can always go back to. So that actually was a big reason for with my family's, policy we just did is, they got a heloc. And it's a great rate right now, but my mom was around in the late 70s, early 80s as a business owner during stagflation. And she was just terrified because she's like, I've seen 22% interest rates on a business loan before. So that was another thing of the strategy is, we can put this through a policy. And then if that ever happens, you can have that as kind of like your break glass in case of emergency plan, where you can pay off the HELOC, the cash out refi or something else, knowing you've got that lifetime low fixed rate. And those could be anywhere, depends on the product. With a whole life right now, for most companies, we're seeing around 5% or so. You can also get like I said, a lower rate, usually through a third party lender. We're seeing as low as 3% right now. Now, most of the time, those are variable rates, but you can also get fixed rates from them too. One of the products that we use a lot now is an index universal life policy, and that has a guaranteed lifetime rate of as low as 2.5 or 3.5%. So that is a really great option for people who are concerned about those rising rates, because that's the whole point, right? Is getting a higher rate that you're earning versus you're paying. So great question on that. So Mike, I don't know if you want to answer this last question, if you want to just kind of move on and open some other questions up as we go in a little bit.
We'll open some other questions up. Let's continue moving a little bit, and then hopefully it might answer the question as we're going, but then we'll get back to the questions as well.
Yeah. And in fact, I think you're going to answer one of these questions right now, Mike, because you have a real life case study from somebody that you worked with at your last BRIA webinar that you just closed a policy for. So I know somebody was asking for some real examples, and Mike's got a great one right now.
Yeah. And so we're going to dive into that real quick, and it should be good. Let's see. So this is a case study on equity versus liquidity, and we'll get into a little bit more of the numbers in a minute, but I just wanted to touch on the value. So we have this beautiful red house right here. I'm going to pretend like I just bought it, and that has some value attached to it, right? And so value increases, we hope, and appreciates. Usually, I think the average is about 3% appreciation. And then we have attached to that a mortgage. And now mortgage decreases as we pay, value hopefully increases. That's why we are investors. And then we have equity, which is kind of that in between. As mortgages go down and value increases, we build equity. But that equity is not really contingent on us. It has nothing really to do with us unless we fix a bathroom up or do certain things inside the house to increase the value. But let's say we do nothing or it's all fixed up, the value really determines what the equity is going to be. But what if you can take that equity and put it into an alternative equity source, a policy that we're talking about today, and then transfer that so that now you have this smaller amount of equity or no equity, and you have one of the cheapest interest rates around, which is our mortgage loan, right? Over that course of 30 years or whatever. And then you have that value of your house. Now, this equity source is going to grow long-term forever because it's the fixed rate, we're growing, we're moving, and it doesn't have anything to do with the value of market value in stock market value or anything like that. It's just going to continue to move forward. Now, 10 years down the road, you might be looking like this. You might have that mortgage paid down, a little bit more equity within your property, and that value hopefully has increased 10 years from now. But you also have this equity source because we pulled that and we're able to utilize that, and it's growing. And so the equity source is growing, your equity is growing, and then your mortgage is decreasing. Now, what happens if a 2008 hits? All of a sudden that flips. And so your value decreases and your mortgage is actually more than the value of your home. This would be a terrible time to sell, but hopefully with good financial planning, your mortgage is not more expensive than than you can handle. And we lost that equity in our property. So if that's what we were losing for liquidity, if it was untapped, we lose access to that money. And so in a downturned market, we no longer have that pool of money that we were hoping for to invest in that next rental property, real estate property, whatever it may be. But since we took that equity out and put it into a source that is liquid, we now have access to this money at the most beneficial time for real estate, right? And so as that market drops and cheap rental properties or cheap properties are opening up, we now have this source of equity that we can go and buy, where others who were just using the heloc to their advantage no longer have that availability. And so you have a little bit of an edge. And so when this is a both and strategy where we can utilize the equity in our properties because it's a phenomenal asset, we can also get another equity source to hedge against something like this where we lose out on that equity source. And so,
Mike, I just wanted to add to that because I'm living proof,
Hmm.
meaning 2008, when the prices started going down, all of a sudden my equity lines started closing on my investment properties. And it was a true domino effect of what was happening. So, having liquidity, right? Like it's great when, prices are down and you want to buy, but if you have no liquidity, good luck, you're going to be on the sidelines. So I wish I knew about this strategy, then. Literally, I mean, it was like, oh, your line went from 100,000 to 0. Because we think your price happens. And that happens to a lot of investors, I know. So it's, again, I think it really comes down to the planning. No one ever thinks about it, right? Like we've seen in this last 18 months, all right, the prices are going through the roof. I'm not saying it reminds me of 2008, but it does remind me of like, hey, you bought something, you made some money, and now everyone's a real estate investor until things go wrong, right? So again, this is to hedge your risk is what, and it's important on what you're talking about today. So.
Yeah, that's a great point. I mean, I got caught in that. I bought in 2006 when you couldn't go wrong with real estate. I was 26 years old. Nobody could have seen, except for people who were paying more attention, that, I would hopefully be now. But at the time, it just seemed like that was a smart, responsible thing to do. And, the value of my property goes down 50% and I'm underwater. I'm hemorrhaging $1,200 a month in negative cash flow. And then I have to move to a more expensive area. It just kept compounding. So it's like everything's going great until it's not, and then it can fall apart real quick. And I think what you said, Mike, is so important that it's almost a hedge with your equity, like Anish said, where you can tap it now, knowing that, if you use it somewhere and put it somewhere safe, then they can't decrease your line of credit. You've already used it, but you've got it in a safe place that's not going to be affected by that lower real estate market. And now you're positioned to actually come in and get even better deals where you can be better off than you were before.
Yeah, definitely. Yeah. And so we're going to get into a case study on this exact kind of strategy here. And so, but before we do, this is kind of the process that we take our clients through as we're diving in and going deeper. The first step is kind of that financial review, right? We want to see the whole picture so that we can accurately paint the picture for you and make sure that we're getting you to your goals a lot better, faster, more efficiently. We don't want to say, this isn't a cookie cutter strategy where it's like, oh yeah, this is what we do. This is how we do it. Here, buy this. That's not how it works. It's very individualized. And so that financial review really helps us to gain the knowledge we need to recommend the best strategy. The next thing is an application. This is insurance. And so there's an application process through our carriers. Obviously, age and health play a factor, but like Ryan said earlier, that there are ways around it. By having insurable interest, you're able to utilize the strategy without having to be maybe in the best health or the age, the lowest of ages or the youngest. Sorry. And then strategy, right? And then so after all that is through, we plan a strategy based around goals and kind of what your financial outlook looks like. And then we implement, right? And the implementation process isn't a buy this and see you later. It's a, hey, let's work together to get your real estate goals going. Let's work together in annual reviews, in biannual, like we want to be a part of your success and watch how it kind of continues to grow. And so Here's kind of one of the clients actually from Berea. The last time I did a webinar, they came to me. They're a phenomenal family. We really, we had a phenomenal meetings. And so I'm going to show you one of their properties and how we kind of turn this into not only cash flow, but into liquidity and into a policy that really is going to benefit them long term and increase their goals and help them get to their goals faster. So we see the primary residence, and I'm only going to get into the primary, but they have a couple other rentals that we're working with as well that we're going to be diving into, not today, but me and them. So anyway,
to interject, Mike, I want to just let know somebody had asked some questions. I think Lily Pinero said, how do you take the equity out to convert as an equity source? And I just want to make sure you understand that's exactly what we're talking about right now. We're going to show you a real life example of how that happened. And then, you know, we can go into some other details that people had questions about, but that's exactly what you're about to show that was really effective.
Yeah, definitely. And so what we saw is the previous mortgage here was 246, right? The previous interest rate was 5.8%. Previous payment was $1,989. Liquidity was around zero. Previous credit card payment was about $1,100 a month. And so during this financial review, we saw these things and I'm like, okay, well, the interest rate for right now, we're in such a low interest rate environment that interest rate can go down by a ton and be super effective for them. And then they're paying some high interest credit card payments, which is working against them, right? Like we said, when money's working against you, it's really hard to get ahead and keep moving forward. And so what we did is we said, okay, let's take some of the equity that's in this property and put it into a new mortgage. And so we did a cash out refi. All right. So that's how we kind of extracted the equity within the property into a cash out refi. What that did was allow the interest rate to go from 5.8 to 3.25, right? So it dropped a good amount. It allowed their payment, their monthly payment to drop to $1,832, right? So they extracted all that money out of their mortgage, but yet they're paying less. And so that's pretty phenomenal. They also now had $70,000 in liquidity. Their credit card payments went down to zero because we want to make sure that we're not paying these high interest payments. What that did for them, they made a difference in their mortgage in $168,000. They improved their interest rate from 5.8 to 3.25% with an absolute reduction of 2.55% and a relative interest rate reduction of about 44%. Their monthly savings or monthly cash flow improved by $157 from their payment. And then the cash flow also improved by $1,100 in credit card payments that they were paying. And so we increased their cash flow, right? Just to kind of sum it all up, they went from 0 liquid to 70 liquid. They added $1,257 in free cash flow. Then they went along with the strategy that we recommended and I recommended, and it's a phenomenal plan. They went from 2.5 million total death benefit coverage, right? They have long-term care protection now, creditor protection, and started a real estate fund within their policy. And so they're on track to now purchase their next real estate property within the next year or two.
That's amazing, Mike. I mean, the fact that they added $168,000 to their mortgage and they still are paying $157 less per month, and that they could use that liquidity from the cash out to pay off that high interest credit card debt. I mean, that's a pretty significant improvement, $1,257 per month in monthly cash flow. I mean, that is, and not to mention now they have got this policy, this other asset that can be used to fund future properties. Hopefully you're starting to see how these things all come together. And I just want to address one of these questions real quick. So there was a question from Joshua about, is it possible or better to move a variable HELOC into the insurance policy instead of fixing the HELOC in a rising rate environment? And yeah, I think in a lot of cases it can be. You always want to just be looking at what's the rate on the HELOC or whatever other loan you're using versus what's the rate you can get in the policy. And that allows you to establish different borrowing buckets, as I call them. So, you know, for my parents' example, their HELOC for the first 12 months was fixed at 2.49% interest only. That's a phenomenal rate, right? They should maximize that as much as they can. But after that first year, it goes up to a floor of 3.75%. So if they put that money from the HELOC and pay the 2.5% that first 12 months, put it in a policy, now the policy, you can borrow at 3% currently. If they paid off the HELOC that was going to start costing them 3.75% and only pay 3%, then you can see how you just kind of go back and forth and use whatever rates and terms are to your advantage at any given time. And so it just depends on the strategy you're using, and again, that's where the one-on-one review comes in. But that's a great point. And that's the way you want to start thinking is like a banker, which bucket do I want to borrow from at a given time and why? So hopefully that answers that. And then
Ryan, I just wanted to add also to that, just so you guys know, right, the difference between a loan and a line of credit, right? So the line of credit gives you access. So if you're flipping houses, and again, it just depends on your strategy. If you're flipping houses, you might want to, like, I stick with a line of credit for me versus a loan because it goes in and out quick enough. The loan, once it becomes a loan, you can't borrow that money again.
Right.
So it's like a car loan, right? So you can't go in and out, you got to apply, or you have to get a new line of credit. So you want to, and it might be exactly what Ryan says, it depends on what bucket and it depends on where you're at. So it might be, if you know for a fact, hey, that 30,000, I'm going to make it a loan to take advantage and lock in those rates. Maybe you keep the other 50,000 or 40,000 on that 70,000 that you're using there as a line to go back and forth. So you kind of want to mix and match and figure out what your strategy is when it comes to access to money. So
yeah, and that's
a
why it's
great
definitely
point.
important to do that financial review so that we can strategize, because to say it's right for you to do this is like, it's impossible to know everybody's situation and where they're at and what their goals are. But yeah, that's phenomenal. And
yeah,
so we
there's
just
an important difference between having in some cases a cash out refi at a fixed rate long term makes more sense. In other cases, I think an interest only variable HELOC makes sense. And again, it really just depends on your situation. So that's a great point to bring up.
Yep. Yeah, and so what we just did is we went from a equity source to a policy, and then that policy is going to be purchasing rental properties. And so now what Ryan's going to show us is how we go from a policy to then a property, right? And so how you use that policy to then purchase a property.
Yeah, absolutely. And I think that was a great example, Mike, of yours. I want to just put this up here too. This is actually from a BRIA client that Mike worked with. And this is somebody different actually than the one he just shared, but another one he's working with right now. And I just want to toot Mike's horn for a second because I did work on this case to a degree with him. And this is from a BRIA client that said, I can't say enough great things about working with Mike Vernicola. I didn't know anything about life insurance before I started working with him, but now I truly see the benefit and value because of the time he has taken to answer my questions and explain everything to me. As many questions as I had, and there were many, he never once lost his patience, but instead dove deeper to help me understand. His knowledge is vast, and he took the time to strategize with me to find the best insurance policy for me. And if all that isn't enough, he is so personable, honest, and caring that it is truly great to work with him. I couldn't agree more. And that is kind of goes to the heart of what you were just saying is you got to sit down and take the time, answer the questions, go through all this. And I know that, you do that really well, Mike. And that's, I think, one of the big things about, all of us at Unbridled Wealth is we really are educating and consulting long-term with our clients. So just wanted to put that out there for you guys. I know Mike personally, and I couldn't agree with this more.
Yeah, make me blush over here. And I think it's a team, definitely a team effort. We all collaborate together and really kind of, we work together to make sure that their clients are taken care of in the best possible way. So
yeah, Mike, I don't know if your wife is going to say you're that patient. I don't know. I know my wife says I'm not that patient. So
yeah, it depends on the day.
maybe you could show her the testimonial.
Yeah, that's what I'm using. Yeah, I got to use that.
Well, Mike, I think you did a great job of using an example where somebody had a real estate property that had equity, and that was used to fund a policy. What I'm going to share now is my own personal case study example of using a policy to purchase real estate. So same thing, just kind of mirror opposite in reverse. So I will just, and I do want to just address a question real quick that somebody said about the kind of insurance policy you use for this long-term care protection. This is something that a lot of people don't know about, but whether it's whole life, index, universal life, most policies now include what's called accelerated living benefits for no additional charge. And that can be a significant source of long-term care. And for my mom, that was actually one of the biggest things for her, because she's a huge believer in long-term care because of what happened with her mom and how long-term care insurance helped her. So it's not technically long-term care, but it essentially functions the same way. And you're getting all that on top of everything else we've talked about. So most of these policies have them. Again, we can go over these things with you in more detail, but that is a really important benefit that I don't usually think about that much being younger, but for especially that older population, or if anybody has one of those situations, they're going to be really glad they have that built in as well.
Yeah.
So for my example, I started out in 2004. I was 24 years old, and my dad encouraged me to get a life insurance policy, which I didn't have the least bit of interest in at the time. And I want to just kind of share this because it wasn't the best policy in the world. I had a standard health rating, which isn't that great. And I was only putting $200 a month into this, $2,400 a year, just came out of my checking account automatically, set it and forget it. And indeed, I did forget it. But it was working for me that whole time behind the scenes. And, again, it wasn't a huge policy. It was only a $250,000 death benefit. I did not know how to optimally structure this at all. But even then, just the power of that compounding over time and getting started early paid off huge. So when I kind of really first got into real estate investing, it was October of 2017. This is 13 years into my policy. Well, that little $200 a month payment that I wasn't even thinking about ever had grown to $40,000 worth of cash value. And this helped me when I combined that with some savings and some lower yield parts of my a non-retirement portfolio, that was enough to help purchase an all cash property that I wouldn't have gotten otherwise, because it was under contract, but the buyer was having issues with their financing. The financing was looking like it was going to fall through. The seller needed to get out quickly and redeploy the capital into another project. So I was able to come in, get the property for a lower price, and get a phenomenal deal that I wouldn't have otherwise gotten because I had that cash value. So once I did that, now I've got my money working in two places, like we talked about. It's continuing to compound uninterrupted in the policy, and now it's making a much higher return in that property. And just to give you guys an idea of the property itself, it was a fourplex in Columbus, Ohio. I was able to get it for $125,000. It had $2,800 per month of gross rent, and I was netting $850 a month after all was said and done over the period that I owned it. So pretty great investment. And wasn't planning on selling it, but just with an opportune time last year in February of 2020, sold it for $175,000. So got 40% appreciation in 28 months, had a IRR net after all fees and expenses of over 18%, which beats the pants off of my savings of 0.15%. So if you compare those two, 0.15, which I couldn't even get that right now, versus 18.26, I increased my ROI by over 12,000% on relative terms, just from moving that money from a place of lower yield into a place of higher yield. Dinesh, did you have something to say?
Yeah, first of all, congrats, man. I love hearing about that. And I mean, that's a true story of him using, his policy. I mean, one of the things that you might want to touch on was how hard was it to get your $40,000 loan back? Meaning, did they do a 1003 application? It took 3 weeks of underwriting to get your 40,000.
Absolutely.
So you want to kind of talk about that, because I know as real estate investors, if you have good accountants, you might be deducting a lot of things. I kind of joke about it. My accountant sometimes deducts things, and I look at it and I'm like, wow, I don't think I can get financing for a bicycle. But when you look at something with that policy, so do you want to talk the process of you found the property, or timeline?
Absolutely.
That would probably help.
Yeah, no, thank you, Anish. I appreciate that. It was super easy. There's no loan underwriting whatsoever. This was directly through the carrier, so it was different than some of these third-party lines of credit we talk about. But it took about a week to get the funds. There was no underwriting. I just was paying the interest rate, and my policy at that time was 3.85%. And that was just simple interest. I was paying it annually, and I got a tax deduction for that too, like I mentioned. But it was a super quick, basically it was essentially a cash deal for all intents and purposes. So maybe at that point it took 7 business days for me to get the check. Again, tax-free policy loan. So I could show up to the closing table, with no issues. That is going to be even easier and simpler if we set up one of these third-party lines of credit where it's literally liquid. You have a checkbook, a physical checkbook, you can do ACH or wire transfers. So that could be even quicker than that process, but it was super simple and easy. And it was obviously the huge difference in being able to get that amazing property.
Yeah, and I think right now, even with one of the carriers that we use, it's about a 2 to 5 day withdrawal, or not withdrawal, but loan period. So you call the carrier and you say, hey, I need $40,000 from my policy, and they'll wire that right to your account within 2 to 5 business days. And so it's fairly quick. I've gotten mine faster than that. We do get, over promise, or no,
under promise, over deliver. Yeah, we'll say 5 business days to be safe, but it could be less, but it's going to be way quicker if you got that line of credit set up.
Yeah. And then now we have a line of credit with one of the banks, and we literally have a checkbook that we can write a check and we have it instantly. So
I have the same thing. And what I could also tell you is, I know if you guys are buying properties and you're building your policy, you could use that as proof of funds too. So I know some people, when you're actually trying to battle other investors and they want proof of funds, instead of having a hard money pre-approval, they could actually see your cash value. I've done it, and they're more than happy about it. And just like you said, I got a check, put it into my account. I could have the money in 24 hours and ready to close too. So
yeah, great point. That's really helpful because as you guys probably know, it's pretty competitive out there as a buyer. So that's a pretty important thing to mention. And just to kind of just sum that up, that overall, net present value from start to finish was over $55,000 in that 28-month period. Got a net total return of 44% between cash flow and appreciation, after taxes, fees, everything else. So, it was a pretty phenomenal thing. Now, though, I am in this situation where I've made, a great investment. I've got net sales proceeds of $157,000 in February of last year. But now it's sitting back in that 0% business checking account for my LLC. And I'm thinking, man, I'd really love to get this money working for me. But again, kind of looking at those challenges of I learned the hard way, how not to invest in 2008. So I was a little worried about putting my money back into another deal, putting it in the stock market. I kind of want to sit there and wait for better deals, but I don't want to be losing 6% to inflation. In fact, we got this poll coming up, and encourage you guys to take a look at that. But that's exactly the position that I was in, was, I wasn't comfortable putting that in because I was worried about that downside. So now I'm just, sitting here in this, it's great that I got this, but, how can I get this money working for me safely and have it liquid on hand so that if a great deal comes up, if there is one of those 2008 situations where, the proverbial blood is in the streets, how can I come in and actually be ready and positioned to take advantage of that? And also be a blessing to other people. If nobody's buying and everybody's selling, you come in with cash ready to go, that's going to be a blessing to people. And it's also going to help you get a phenomenal investment. So my big question at this point is, where do I put my money, right? Well, luckily I talked to the same guy that Mike did at Unbridled Wealth and learned a lot more about how to use this infinite banking concept. I kind of backed into it, what I just talked to you guys about without really knowing how it worked. I just kind of, it just worked out that I was able to use that, but I didn't understand how to structure it. So with those sales proceeds from the property, now I put that money back into a much more optimally structured, great policy. I did what's called a 1035 exchange, which is basically the life insurance version of a 1031 exchange, which you guys are probably familiar with, a like kind exchange where you can do a tax-free transfer from one to another. And I've got this $900,000 death benefit, which I don't really need right now, but it's nice for, down the road. But more importantly, I've now put my money in a place where it's earning that long-term return of about 4 or 5%. And that is really important because Now that idle cash is working for me. And just on a psychological level, it was so important because I don't have that money burning a hole in my pocket, thinking like, I got to do a deal. I got to do a deal. And like kind of the tail wags the dog. Like I want to have the patience to wait for a really great opportunity like the one I had before. Kind of got spoiled on that first deal, you know, with how great that went. But I also understand not doing something just to do it, because I lost a lot of money in 2008 that way. So by knowing that the money's still working for me, it allows me to be patient and wait for better deals. I'm building equity, just not in a property, it's in a policy. And again, we talked about that liquidity, you know, you get a check in 2 to 5 days, even quicker if you've got the line of credit. But most importantly, that equity is not tied to real estate or the stock market. So if the market crashes, not only am I not hurt by that, I can actually prosper instead of perish in those kinds of downturn situations. So I'm well positioned and I can wait for those good deals at the right time.
Hey, Ryan, can you actually talk, or you guys talk about like the values not going down in your policy? Like, let's say the stock market, you know, like 87 or whatever, like something like major correction happens.
Yep.
Will their cash value go down? Or, I mean, I know the answer, but how that really works. You know, if it's tied into the market, you always hear that, well, it's tied into the stock market. Right. My value goes down.
No, it will not. If it's a whole life policy, not only will it not go down, it is guaranteed to go up every single year by a certain amount. And then on top of that, there's a non-guaranteed portion of the dividends that fluctuate from year to year. But with a whole life policy, it's guaranteed to go up every single year at a certain rate. With an index universal life policy, it's not guaranteed to go up at a certain rate, but it's guaranteed not to go below 0%. You know, you've got a 0% floor, so that if you're investing in an index, say the S&P 500, then you'll get up to as much as, you know, 9, 10, or even more, you know, percent per year on the upside. You won't get more than that. If the stock market does like 25% one year, you're only going to get that cap of around 10%. But the flip side is you're not going to get worse than 0%, you know? So that's really important.
I think that goes right into that whole question that they just answered, where do you want an asset that benefits from stock market gains but protects against market losses? And that is an IUL product, which you can do. It's not really, we don't like to say it's infinite banking, because it would do a disservice to Nelson Nash, who kind of had the idea of infinite banking. But it is privatized banking, which IULs can definitely be used for if it's structured properly and you're reducing the amount of insurance to maximize the amount of cash value. It can definitely be something that is looked at as a banking strategy.
Yeah. And, you know, of course, being transparent. So I'm doing all that. I mean, I am using that third party for the line of credit, and between the dividends, and I'm also lending and the arbitrage. Last year I made an extra 20%.
Wow.
On my money doing nothing.
That's amazing.
Just kind of moving and kind of working on myself. You know, and I'm gonna admit, like I'm a culprit too. Like here at Berea, we get to meet very smart people like you guys, and some of our other vendors that are part of our group. And you know, I was busy with life. I mean, oh, I'm too busy, I'm doing this. And if you know anything about the pandemic, what it did for me was it was a reset on my own personal finances. And now it's exciting to see the difference of, you're like, oh, you know, and last year actually I got 10% on my dividend check. So I was like,
that's incredible.
You know, like, how is this happening? Like, you know, doing these little things. So like, that's why, you know, that's one of the reasons I'm so excited to have you guys here, because it's a little nerdy, but once you start seeing this, and also to touch on something else that, you know, some of you guys, you know, are wondering how to get funding for your deals. You might have a family member that has a policy, or, you know, maybe have them move it and go into this, and they're lending you the money, right, for your deals. You can make it a win-win, right? And so if you're new and you're saying, I only have a little bit about, you know, I only have a little bit of money, I'm not really sure in my job, we got too many things going on. There's people in your circle that may have this, and it could help fund your deals. Yeah. So I think it's a lot of benefit that, you know, that you could really learn these processes and execute. So.
Yeah, and you could even be the lender potentially in that case. If you're the person with the cash value in the policy that you're not using, then that person, like you said, it's a win-win. And that person's making an excess return because, yeah, they're borrowing at say 3%. If they're making a loan at 5%, but it's interest only, or it's more favorable than what the person could get to do their deals. I mean, hard money lenders are going to charge probably what, 10, 12, 15%, something like that.
Yeah,
So,
exactly.
you know, it is a situation that you can engineer financial win-wins for sure.
Yeah, I mean, it's like once you start peeling the onion a little bit, the great thing, I always like talking to these guys because they get a bird's eye view of what their clients are doing, right? So they could even, not to get too technical, but you could even wrap that lending by using someone else's heloc or not heloc, or their line of credit that they're using on their policy. So maybe they'll lend it to me at 6%. I'm gonna, you know, I need to make money, so I'm gonna be like Mike. I'm gonna lend it to him at 11%. I'm gonna make the 5% endpoints, and I'm not using any of my money. So there's a lot. Like once you start getting into it, you're just like, wow, you know, you could really, you know, exponentially grow your business.
Absolutely. In fact, that's why we got into what we're doing now, like we said earlier, and that goes to a question that just came in. He's asking, do you guys sell the life insurance or would you recommend one? Yeah, we do. We both of us, because we use this in these, you know, personal case studies like we're talking about, and all the benefits that Anish is saying. You know, first I was just a client and policyholder and an investor. And then once I saw how this works so well, I was like, man, I need to tell people about this. And then for me, I just happen to be, again, a huge numbers and finance nerd. I love helping people understand these things. So it was a perfect fit for me to do it full time. So if that wasn't clear, I apologize. Mike and I, yes, we both are life insurance agents. We specialize in this concept and this strategy. We are with Unbridled Wealth. We're independent contractors. We don't own the company. We're not part of the insurance carrier directly, but it's kind of the same way a realtor, you know, a real estate broker would work. You know, you're a 1099, and then you work with another firm. So, you know, as far as any regulations, that was another comment. It's just, you know, at this point, again, we're not CPAs, investment advisors, lawyers, anything else. So the only thing that governs this is just the state life insurance laws. So it's a simple old product that's been around for hundreds of years. It's just using it in a very unique and strategic way. So hopefully that answers some of those questions. And I know we're getting close to our time. So just to wrap up here, I did get a question from Lily that she said, if you have 6 properties with great equity, what will you do with that? Selling all the properties and reinvesting in the policy, or just the equity money from the cash out refi? Well, again, it depends. There's no one size fits all answer, but that's a great question that we could talk about. What I would say is, if you've got, especially if those properties are cash flowing, you've got tenants in them, you've got, you know, and it makes sense, kind of that whole idea of the infinite banking concept, whether it's a policy or a property, is rather than selling it, just collateralize a loan against it, like a cash out refi or a HELOC, hold on to the property, let that keep appreciating, get the tax benefits, get the liquidity. And then, you know, what Mike did and what my, you know, parents just did that I helped them with was take that equity and liquidity from the property, put it into a policy, and then you've got both of those things working for you at the same time. So again, it's not a one size fits all answer, but you know, I think that's a great potential option for you in that situation. And that's one of the things that we ask about. And we also have a poll question that just came up about being an accredited investor. There are some phenomenal opportunities in the accredited space that Anish probably knows about from doing, you know, syndication deals and private placements. But there are, I mean, that blew my mind. That opened up a whole other world in the last year from working with savvy investors using the infinite banking concept.
Yeah, absolutely. So I just put that, and the reason I put that poll up there is like, we're just kind of giving you a taste. And exactly what Ryan and Mike are saying is, if you are accredited, you even have more options. So it gives us a good idea of how many people are accredited or interested in it also. Can I hit some questions before we close out? So Denise is asking, can you contribute a one-time fee and let it compound over time, or do you have to contribute to the insurance plan monthly?
There are options to do a one-time fee. It depends on what kind of policy we're looking at and what we're looking to do. But yeah, you could definitely do that.
Yep. And actually, I know Denise is one of our coaches. So I'm going to give a follow-up question that because they got some new grandkids that just happened this year. Can they, like, if they, you know, they're flipping houses, signing contracts, let's say they make 25,000 on a house. Can they just put the full 25 in and do a policy for their grandkids? I know she's going to probably ask me that later, or is that something,
yeah, you could definitely do that. I mean, I think it depends on obviously NAR, net amount of risk, but I think, yeah, you could definitely do something like that and let it sit. juvenile policies, Ryan, do you know if you can do a one-time dump for a juvenile policy? I think that's what you're asking, right, Anish?
Yeah, that's what it
Talking about like a
basically is.
single premium payment and then nothing ever again.
Yep.
It's not ideal. Like sometimes banks will do single premiums and it's a whole different concept. It's usually not going to work. You want to pay at least several years into it. If it's a whole life policy, you've got to make a base premium payment, which will minimize to reduce the cost of insurance and optimize the policy structure. But you're going to have to pay into that, generally speaking, at least 7 years to avoid tax consequences that would happen. But you could always do what's called a reduced paid up with the whole life policy. So if something happens and you just can't make the payments, or you hate it and you don't want to do it anymore, rather than surrendering the policy, you can just say, hey, I'm not going to pay any more into this. And then it can still continue to grow and compound. But we really want to target like those maximum overfunded payments that you can sustain for at least a 5 to 7 year period. Could be as low as 3 years, maybe, with an indexed universal life policy. So, but generally speaking, it's not a good idea to just make one big premium and then that's it. You got to fund at least a couple years early on. Now, you could drop those premiums significantly after that first year. You could even borrow from the policy to pay the policy in future years, which is actually, what some of my clients are doing. But just because of the way the life insurance is structured, it's not meant for a one-time big dump in. You got to have some kind of ongoing payment for a few years after, but it could be significantly less than that first one.
Yeah. And I know that's, again, it's a case by case study, but I know a lot of people, like one of the things I do, because, when flipping houses and assignments. So, we talk about the maximize allowance that you could do per your policy. It's funny because I kind of just generate that. I have that number in my head already, knowing the amount. So I said, okay, for every 5th or 6th house I flip, it's going right into my policy as chunks, because, and I kind of build that in, like in my life. I know people do it differently. I build in my vacations the same way. My wife and I went on a great vacation, to Dubai and Turkey. I built that cost in. I was like, hey, let me just flip that extra house to do that. So it is possible if you're not on a set income. I think it's always important.
The important thing too, and what we really didn't cover too, there's so much to cover that, we only get into a few intricate things here in this 90 minutes, but the first year is going to kind of set the ceiling. The remainder years, the rest of the years, you have the flexibility. And that's what's nice about it, is it is flexible to adjust how much you're putting in, essentially. So it's not like you have, if you did $100,000, you have to do 100,000 for however long, but you have the flexibility. So you do really well in real estate, you can do $100,000 for the next year, then you can drop it to the base premium, then you can put additional in the following year. And so there is this flexibility of it as well.
Plus, if the property, sorry, go ahead.
And what I was also going to say, based on most illustrations that I've seen, if you maximize your policy, which we're talking about overfunding, there'll be an amount like these guys will give you, so you don't have any IRS issues. But if you overfund, I think if I'm correct, and I might be wrong on this, but it's usually 5 to 7 years, and that should cover your policy because of the dividends. Like if I put the maximum amount for 5 to 7 years, is that what you guys are seeing, that in 7 years I probably won't have to put any more money in?
Yeah, if you stick with that maximum overfunding schedule, whether it's an index universal life or whole life, generally within 5 to 7 years, depending on the product and the situation, you should never have to put another dime in ever again. And you'll see that continuous compounding over time. And that's usually what we're doing, is a 5, 7, or 10 year payment schedule. And you could keep going if you wanted to, but generally, if we do it right, that's all you got to do. And then you just reaping the benefits the rest of your life.
Yeah. And I'm going to add to it, because I know we could have done a whole full day of stuff. So the cool thing is, because that's what I'm doing, I'm on year 4. So I'm almost there, like I'm feeling it. But the cool thing is, like down the road, that money, as it keeps growing and compounding, as I take out the money, it's tax free.
Yes.
So that's the big, the long-term care, which is great. This is probably the healthiest I'll ever be, meaning as you get older, things are more broken, it feels like. But, if I would have done this, like you said, you started at 24 or whatever age, and you did it for 7 full years. Or if I was diversified in 2006, 7, or, when I was making a ton of money, and not putting it all in real estate, I would have had a parachute.
Yes.
Besides the obvious stuff with asset protection and like, there's like a crazy amount of benefits of actually structuring it the right way.
Yeah.
Yeah.
And again, we've only scratched the surface, and I know we're already past our time, but really the best thing we can do to answer more questions is just to follow up with a one-on-one appointment. So I'll just in closing share this last slide of, this is kind of the customer journey, as we call it. Schedule an appointment with us. We'll review your financial goals and objectives. We'll get you into the underwriting process. There's no cost or commitment to that, but at least we get the process started where you have the option, but not the requirement. We'll do that strategy and policy design. We'll make specific recommendations. And then once we get that offer from the carrier and we've figured out your whole situation, we'll go ahead and implement, and then we'll follow up and adjust every single year. So again, you can take a picture with your phone right now of that QR code. That'll go straight to the link, the calendar appointment. And then there's also, if you don't have a phone on you or whatever, then we can put that in the chat again. But I hope that was helpful for you guys, and thanks for letting us come on and share this.
Absolutely. There's two more quick questions. Like, if you don't mind, I'll just
absolutely.
kind of go through.
Yeah, we're good for as long as you are. I just wanted to respect everybody's time.
Okay.
So
Yeah, we're good. I'm good because this stuff is always, and these are great questions. They're like, someone's asking, that's an interesting idea. Can you comment on the process and cost to transfer an existing property in a personal name into the policy in order to access the equity?
So you're not actually transferring the property into the policy. That is a difference between the self-directed IRA and the policy structure. You're just taking the liquidity from the property and putting that in, whether you're funding that out of, your W-2 income as a salaried employee, whether that's coming from, selling a home or doing a cash out refi, you're just putting the money in there, but the property isn't actually going into the policy. It's just the way that you can fund the policy with that property, if that makes sense.
Yep, absolutely. I just want to make sure we clarified. And I know someone's asking, the property with equities and under LLC, can it be used for this concept? It's the same answer. You just do a refi in the LLC, take out the cash. So if you guys do need lenders, with our network, we have lenders that will lend on the LLCs. So it doesn't really, again, you're not transferring the property into the policy.
Right.
Exactly. You're just putting the money in.
Exactly.
Mike, I
think it's always.
Sorry.
Yeah, go ahead. I'm sorry.
I noticed that we did have a couple of accredited investors, which is a whole world that we don't have time to go into. But I know, Nish, you said, maybe just very briefly mentioning this idea of premium finance, which it's going to be certain restrictions and requirements, but that's a phenomenal thing we haven't even gone into. If you're accredited, there's probably a decent chance you'd qualify for that. So that's something I just throw out there. It's just in a very quick nutshell. Premium finance is where, rather than you paying the premiums into the policy, a bank will actually lend and pay the premiums on your behalf. It's kind of like a mortgage, except you're getting way better rates and terms. You can get 100% financing. Right now, it's a 2.5% interest only rate, which I've never heard of rates that good. And it just supercharges, a very, very small out-of-pocket contribution from your own capital. You're using incredible leverage, but very safely, because again, you've got that downside protection. So if you're accredited or you've got a certain amount of income and net worth, each lender's got different requirements. That could be a very, very powerful strategy I've used with some of my clients, where we combine premium finance with your typical self-funded IBC, and the combination is explosive, especially with accredited investments like what Nish is doing with private placements.
Yeah, thanks for sharing that. And again, so today, I know some of you guys might be overwhelmed, right? You're saying, what the heck is going on? So I invite you, again, these guys don't charge anything. Get a financial picture of where you're at. And the other thing I think it's always important is, maybe you're not in that situation where you have that much disposable income. You want to figure out your path. Maybe one of the questions I might have is, how little can someone get started to use any of these concepts? Like what, I know it depends on the age of the person that you're looking at for the insurance policy, but like, would you have a minimum amount that you've seen with your clients? As little as? Yeah,
I feel like the smallest policy I've done is probably about 100 a month or 200 a month. But there is also, we work with a lot of clients to kind of strategize with them to say, hey, maybe you're not in the period of time to do this right now, but that's where a term policy, and we're not completely against term, might be something to lock in a health rating And then as you follow steps to becoming financially free, or in this state where you can start in growing a policy, that might be an opportunity to then start funding it. I have a few clients right now who are doing a conversion from a term policy to a whole life policy, because now they're cash flowing. They followed a plan that now got them from where they were to where they want to be. And so now they're ready to start building in a whole life policy and utilizing this IBC strategy.
Yeah.
So
I mean, Ryan is the perfect example.
right.
2004, $200 a month, you know, and lo and behold, he's got enough money to buy a property by accident, right? Like, I mean, your dad did the work there, but lo and behold, you're like, oh, now I got something. I could actually, as I'm learning real estate or other, you know, investments that you're doing, now I have access to money. I think the other big thing is that as real estate investors, and as you're starting to build your career, and I mentioned that you may or may not have the money for the deals. If you don't do this for yourself, you can't tell people in your circle, hey, this product is great, and then have them invest with you. So that's the first thing I would say. It's like, hey, Nish, it's so great. You know, Brian and Michael, you know, they're talking about some great stuff. Are you doing this? I'm that guy that's in your face that says, yeah, great. Are you doing this? And if you're not, why is it so great for me and not for you?
Yeah, that's such a great question, Nish. I remember one time I was looking into a deal a couple of years ago, and all these guys were telling me, oh, this is great. And I think they were getting a referral fee. I'm like, okay, so how much are you guys putting into this deal? Oh, nothing. So it's a great deal for me, but not for you. And that's why the only reason we got into this is because it worked so well for us. We're like, well, shoot, let's tell other people, and we enjoy doing it. So, you know, I think it's important to look people in the eyes and tell them, like, you know, I'm putting my money where my mouth is. And I appreciate you sharing your experience too, Anish, because you've seen all the benefits. It's pretty amazing.
Absolutely. And one of the things in the chat before we go, if you guys liked what these guys were talking about, would you guys be open for a more advanced? I know we kind of, you know, strategy. I know we have a lot of newbies on here sometimes. So just put in the chat if like, hey, we'll have these guys come back and we could kind of, you know, do some more advanced things of what their high net worth clients are doing, and just kind of, I hate to say it, copy them, because it already works for them. So go ahead and put that in the chat, because I'll push these guys to come back again and, you know, get their hands really dirty. That's what I tell them. And the last thing, I want to thank you guys for, you know, spending the time with us. Tomorrow also, I know some of you guys were talking about, you know, you have equity in your properties. We're doing the BRRRR method. I'm going to be teaching. We're going to have a real case study, and then combining it with short-term rentals. So that might be part of it, you know, refinancing some of the money out, putting it into a policy, getting a third-party line of credit, and combining all these strategies at once. So, which I am actually doing too. So the first step is to do one, and then you're like, oh, okay. Yeah. And so tomorrow we're going to be going over, you know, those properties that you do have equity in, and how to get that money and maximizing your cash flow for the month. And, you know, hopefully you'll enjoy us tomorrow at 7. And any last words you guys got that you want to give our audience?
No, I think the best time to start is right now. You know, if you haven't started, and obviously that's coming from me, but it's true. You know, I think we always hold off, but the longer it has to compound, the more efficient it's going to be. And so it's definitely recommended to dive in and take a look at it at least to see something that you want.
Yeah, like if they do like a meeting with you, and like my point is, like, the process is relatively quick. I know you talked about the application, all that stuff, but you could be from beginning to end, once you figure out your plan, I imagine within a couple of weeks you're up and running.
Yeah, I'd say 4 weeks probably with everything.
Yeah, it depends on how big the case is, but you know, it could be as quick as a week. It could be as, you know, 2 or 3 months. It just depends. But I mean, to Mike's point, I think, you know, just scheduling the appointment, taking 30 minutes, and if nothing else, learning something, even if you don't do it, you know, it's just another thing you become familiar with. And the more that I've done this with more people, the more things I'm learning, like everything about accredited investments. And I think it's just another way to raise your financial IQ. But again, like, it's never too late to start. It's you know, no amount is too small within reason. It's just getting that started sooner than later. And if you can't do it now, we can always follow back up with you and check in later. So
and by the way, Ryan, you're way nicer than I am, meaning like you got to be in action. I mean, seriously, like you work too hard. What the heck are you waiting for? Like in general, like,
Yeah.
you know, I hate to say with the pandemic, that's been a reset button of what's happening in the world. You know, you take your health for a bit, you know, granted, all these things, you got to be in action. Like, aren't you tired? Like and for me, I was just tired of being on the sidelines.
Yeah.
So when's it going to happen for me? You know, so as I said, Ryan's a nicer person than I am. I just, you know, we put on these webinars and we give you real education because we want you to use this.
Yeah.
We want to share the information. We have partners that we trust and believe in. And, you know, I mean, that's why you're even tuning in today. So.
Yeah, absolutely. Appreciate it. Thank you guys so much for having us. It was great
Yeah.
being here. And, you know, we hope to be able to follow up with you guys again in the future.
Yeah.
Yep,
Thank you, guys.
absolutely. And also, if anyone actually wants to email me and you could ask me, I'm pretty I'm transparent, so I'll tell you what I have going on. So just in case, but if there's specific questions on, like, I'm not that guy, these are the guys. So
Cool. Yeah. Thank you, guys.
Thank you guys so much. We really appreciate it. We do have 4 winners for today's webinar. I'm just going to quickly announce them and then we'll coordinate later to get their prizes. So I just want to congratulate Lily Pineros, Maria Sanchez,
Congrats.
Michael
Right.
Jackson, and Lance Minto. Congratulations, everyone. We're so happy for you, and we'll definitely contact you today to obtain your prize.
Awesome.
Congratulations,
thanks,
guys.
guys.
Yeah, appreciate it.
Yep. Have a good rest of the week. Thank you.
Thank you so much, everybody. Have an amazing week. Have a great rest of your day, and we'll see you tomorrow night at our monthly meeting.
All right. Beautiful.